it is my esteemed pleasure to introduce Mr. and Mrs. Donald Trump.
It's the Donald! Oh my God!
Look, folks, before we go too far, I've got something to tell you.
Excuse me, but I've got something to tell you first. Thank you for ruining my life!
Ashley!
What did you do?
Everybody's always blaming me for everything.
We're going to have another catastrophe sooner than later. It'll be bigger than 2008, but the next one's going to be strike 3. We've had 2 warnings. They've been ignored. The 3rd time, it's game over.
Hi, I'm Mike Maloney, and I want to thank you for being here. The reason that I'm making this video is I believe that there is something very big and very dangerous coming at us very fast right now, and I want as many people to be prepared as possible. This is the first time in history that there has been an everything bubble. This, back in the year 2000, it was stocks. In the year 2008, it was stocks and real estate. This time it is stocks, real estate, and bonds, and they're all in some of the biggest bubbles of all time. And when this bursts, it's going to be devastating for most people, but it doesn't have to be devastating for you. So this is how to survive the next 4 years. It has nothing to do with either political party. This is just finance. This is just economics. The next bubble in our everything bubble is the real estate bubble. Now, in 2008 and 9, real estate crashed in the United States and Great Britain, but in Canada, Australia, New Zealand, and China, the real estate bubble just took a breath and kept on running. This is an article from Maclean's. It's a Canadian publication, and they're saying that the Canadian housing bubble looks disturbingly familiar. And this is another article that says Home Capital, they're the biggest mortgage lender in Canada. Their stock plunged after the mortgage lender seeks a $2 billion credit line, and that credit line is basically a bailout from the Bank of Canada, Canada's central bank. So the bailouts are already, this is a credit line that they're going to be guaranteed, but what's going to happen is the crash will start and this will turn into a bailout because it's going to be much bigger than just this $2 billion. What is happening is there's a run on home capital right now. $600 million worth of deposits have been withdrawn recently, making them unstable, and their books are not that sound. So here's some of the Canadian real estate evidence. This is the price of homes compared to the income of the buyer. So this is the affordability index. And you can see the peak in 2007 for the United States and then the crash. And in Canada, it just took a little breath and then kept on running. And the peak is way above where we were in the United States and Great Britain back in 2007. So this is going to be something bad. This is the home index of home prices. So the last one was the affordability, and Canadians are being crushed right now. They really can't afford their homes if they're buying new ones. But the prices, the home prices, you can see that we crashed and then are rebounding back into a bubble, and they're in a hyper bubble. So what I see here is that this crash could start in places like Canada, Australia, New Zealand, or somewhere else around the world, China, and it'll start to sweep over the world. We're overdue for a recession, like I said, and there will be a devastating crash here, and it'll go into real estate and the stock markets because our real estate is also in a bubble in the United States. This is Robert Shiller again from Yale University. His data, and he's got home prices here going back into the 1880s, and they're indexed. So if everything was at fair value compared to the rest of the economy, this would be a straight line. But when home prices go above or below the rest of the economy, home prices were a bargain here during the Roaring '20s and the Great Depression, and then they went into little bubbles in the 70s and 80s, a hyper bubble in 2007, and that popped, and it didn't even bounce down to fair value. and then it went back into a bubble. And what I want you to see here is that where we're at today, there's only been in a bubble this big or slightly larger for just 2005, 6, and 7, just a few years in all of this data going all the way back to the 1880s. So this suggests that when the next recession comes, we are going to see stocks and real estate crash. Now this gives me such a sense of deja vu. It is eerily similar to the last time around. If you replace the name Home Capital with either Northern Rock in Great Britain or Countrywide in the United States, those entities got into trouble. Their depositors started withdrawing funds. The mortgage-backed securities came back to bite them in the butt, and they needed bailouts, and it caused this cascading effect of the global financial crisis of 2008. And here we have Home Capital, and the same story is starting again.
Now, you've expressed some concern in the past for the impact of a Fed rate hike on the housing and auto sectors more specifically. What do you see as the vulnerability there?
Well, these sectors are completely dependent on cheap money. I mean, people buy houses based on their monthly mortgage payment. And fixed rate mortgages, the 30-year fixed rate has basically gone from about 3.5% when Trump was elected to 4.5% now. It could be over 5% by the time he's inaugurated, and it can easily be close to 6, next year. I mean, nobody can afford these rates. We already have home ownership near a 60-year low because people can't afford the low rates we had. Obviously, they're not going to be able to afford the higher rates that we have now or the rates that we're getting in the future. So you're going to see a drop there. You're going to see a complete end of the refi market. So that lifeline is gone. People are able to rely on lowering their payments with refis. Nobody can do that anymore. And I think now with higher cost to borrow money to buy houses, real estate prices are going to start to fall, so that means more foreclosures again, so that's a problem. And the auto bubble, this has all been about 0% down, letting people roll the negative equity in their trade-ins into an even bigger loan with cheap money. It's been about leases and extending the payments. This is a huge subprime bubble, and the air is already coming out of that. Yeah. So all the things the government propped up with cheap money are going to topple as you take the cheap money away.
We don't have real capital investment. We don't have increasing productivity, because the Fed is diverting all those resources to propping up speculative bubbles in the stock market, in the real estate market, in the bond market.
Did you know that the rate of home ownership in the United States has fallen to a 20-year low? Did you know that it's been falling constantly for an entire decade? For the past couple of years, the economic optimists have been telling us that the economy has been getting better. Well, if the economy really has been getting better, why does the home ownership rate keep going down? Yes, the ultra-wealthy have received a temporary financial windfall thanks to the reckless money printing the Federal Reserve has been doing. But for most Americans, economic conditions have not been improving. This is clearly demonstrated by the housing chart that I'm about to share with you. If the economy really was healthy, more people would be getting good jobs and they would be able to buy homes. But instead, the home ownership rate has continued to plummet throughout the entire Obama recovery. I think that the chart speaks for itself. Of course, this home ownership collapse began well before Barack Obama entered the White House. Our economic problems are the result of decades of incredibly bad decisions. But anyone that believes that things have turned around for the middle class under Barack Obama are just being delusional. If the US economy truly was in good shape, the percentage of Americans that own homes would not be at a 20-year low as they are today. The US home ownership rate fell to the lowest in more than 2 decades, as many would-be buyers stayed on the sidelines, giving the rental market a boost. The shares of Americans who owned their homes was 64% in the previous 3 months. The Census Bureau said in a report, the rate was at the lowest since the second quarter of 1994, data compiled by the Bloomberg Show. Rising prices and a tight supply of lower-end listings have put homes out of reach for some entry-level buyers. who also faced strict mortgage standards. And it appears that this trend is actually accelerating. So why is this happening? Well, in order to buy a home, you have to have a good job, and good jobs are in very short supply these days. Over the past decade, the quality of the jobs in our economy has steadily declined as good jobs are being replaced by low-paying jobs. In addition, government policies are absolutely murdering small businesses. At this point, small business ownership in the US is hovering just above record lows. This has resulted in millions of people falling out of the middle class bracket, and it has contributed to the growing divide between the wealthy and the rest of the country. If our economy was working the way it should be, the middle class would be thriving. But instead, it is being systematically destroyed. Back in 2005, the home ownership rate for households headed up by someone under the age of 35 was around 43%. Today, it has declined around 35%. From a very early age, we push our young people to go to college, and today more of them are getting secondary education than ever before. But when they leave school, the good jobs that we promised them are often not there, and most of them end up entering the real world, already loaded down with massive amounts of debt. According to the Pew Research Center, close to 4 out of every 10 households that are led by someone under the age of 40 are currently paying off student loan debt. It is hard to believe, but total student loan debt in this country is now actually higher than the total credit card debt. At this point, student loan debt has reached a grand total of $1.3 trillion, and that number has grown by an outstanding 84% just since 2008. If you are already burdened with tens of thousands, or in some cases hundreds of thousands of dollars of debt when you get out of school and you can't find a decent job, there is no way that you are going to be able to afford to buy a house. So, we have millions upon millions of young people that should be buying homes and starting families that are living with their parents instead. Back in 1968, well over 50% of all Americans in the 18 to 31-year-old age bracket were already married and living on their own. But today, that number is actually down below 25% of people. Instead, 31% of all US adults in the 18 to 34-year-old age bracket are currently living with their parents. Something has fundamentally gone wrong. Our economy is broken, and anyone that cannot see this is just being foolish. So, what is the solution? Please feel free to share what you think by posting a comment below. Finally, if you're new here to the channel or you've been spinning around our videos for a while, be sure to give a tap to that subscribe button there and turn on the notifications so you'll know the next time we post a brand new video. God bless you.